The Fibonacci retracement tool is one of the most used tools by traders due to its precision, and yet most of the people still use it wrong until today. Welcome to Crypto, my name is Xavi, and in this video tutorial you will learn everything you need to know about the Fibonacci retracement tool. And don't worry if you are a beginner or already an experienced trader, because this video is made for everyone. Let's dive straight into it. The Fibonacci retracement levels are nothing but just simple horizontal lines that indicate where support and resistance is likely to occur. The indicator is very useful because it can be drawn between any significant points, such as a high and a low, and then indicate with horizontal lines, also called the retracement levels, where is the price likely to react. But the most fascinating part of the tool is that its history has proven it to be very useful and precise at predicting reactions of the level it marks. Now, the Fibonacci retracement levels are the 23.6%, the 38.2%, the 61.8%, and the 78.6%. Now, while not an official Fibonacci ratio, also the 50% level is used. So basically, the Fibonacci retracement tool, what it does is divide a movement. In this case, the movement would be from this important point to this important high over here. So basically it takes this point, which will represent 100% of this movement from down here to here. That would be our 100% movement, and what it does is dividing it between levels. So basically from this point to all the way down to the first level, it would be a 23.6% retracement, then all the way here 38.2%, 50%, 61.8%, and 78.6% retracement. So basically from the highest point of this whole movement, the price would come all the way down here and retrace up to a 78.6% to most likely react. Now, according to the principle of the Fibonacci retracement tool, we could also expect a bounce in any of these levels. So in the 23.6, in that one, in the 50%, in also that one. But anyway, all you need to know about these numbers is that they come from something called the golden ratio. The golden ratio is derived from the Fibonacci numbers, which is a series of numbers where each entry is the sum of the two preceding numbers. So as you can see down here, 8 comes from adding together 3 plus 5, and then 13 comes from adding 5 plus 8, and so on. Now, the interesting part here is that if you divide one number by the next one in the sequence, you will get 0.618. Now, if you divide a number by the second one in the sequence, you will get 0.38, and so on and so forth. Now, before you start speculating, no, there is nothing special about this Fibonacci retracement. It simply works because we have seen the presence of this golden ratio in many fields. For example, in honeybees, if you divide the female bees by the male bees in any given hive, you will get a number around the golden ratio, which is 1.618. Or sunflowers, which have opposing spirals of seeds, have a 1.618 ratio between the diameters of each rotation. The golden ratio has also been found in geometry, in human DNA, in galaxy formations, cells, historical artifacts, architecture, and a long list of other fields. So basically, because we've seen this number in so many different places, we humans, the ones that control the numbers we see on the charts, started using it in finance too as a reference for taking profits, setting stop losses, opening a trade, or even investments all around these levels, which, by the way, that's what it's called, the self-fulfilling prophecy, which apply here. We can say that the more traders use the Fibonacci retracement tool, the more effective and precise it will tend to be. For example, now that I told you that it is pretty likely that the price will react, let's say at the area of 0.618, which is a Fibonacci level, it is also pretty likely that then when you are considering to open a trade, you will probably be expecting a bounce or at least some reaction around this level, leading you to most likely, let's say, open the trade here or close a trade here or take some sort of action, but on this Fibonacci level. It could be anywhere you could take some action, but because now you know of these levels and because you are using this tool, it is most likely that you will use it again, and that's simply because the more people use it, the more effective it will be. Self-fulfilling prophecy at its finest. Now, I know this is not very intuitive to understand, so I would like to summarize all the concepts I went through by redoing from scratch this example I've been using for the video. So basically, I will delete everything here and I will start using the Fibonacci retracement tool from scratch with you. Now, first of all, to start using the tool, you need to open the Fibonacci retracement tool, which, depending on where you're doing your analysis, will be in a different place. But in my case, I'm using TradingView, so I can just come here and then find the Fibonacci retracement tool. So basically, as I said, we want to use it from two important points. In this case, it will be from this minimum to this maximum, and we're going to consider this our full movement. As we can see here, we have a massive movement, and then as soon as we see that the price starts retracing, then that's where we want to use our tool to see how much it can retrace, because it's been going so much up and now it started retracing that we want to see how far it can retract before continuing potentially going upwards if we don't break the Fibonacci levels. So basically, we're going to draw it like that from here to here. Now, as you can see here, this tool looks quite different as the one I've been showing you in the first example, and that's just because it comes with the default value that I strongly suggest you to modify. For example, first of all, here it shows us the retracement of the 0.236 and 0.382, which honestly I don't use in my analysis, and the reason of that is because the probabilities say that when a movement starts retracing, it is most likely that will retrace at least a 50%. So for example, if we are using the level of the 23.6% and 38.2%, it is most likely that then when the price comes here, instead of bouncing, it is most likely that it will continue going downwards. So instead, you should not use it if you want to, for example, enter a long or a short position, and because of that, I'm not going to use them. In fact, it shows you here more levels that are not even part of the retracement tool. That's for another type of analysis, so we are not going to use them. So we want the level of the 0 where we finish our movement up here, and then the 1 where we start our movement, and then we want to see the 50% retracement, and then the 0.618 and 0.786, which by the way, between those two levels, that's what's called the golden zone, as statistics show that when the price enters between these two levels, there is normally quite a strong reaction. I also like removing the background so I can see through it, but anyway, that would be our setups. Now, after customizing just a bit the tool, I'm gonna draw it again here from the minimum to the maximum, representing our full movement here. So basically the full movement from here all the way up here. But what are we seeing right now? What is this Fibonacci retracement tool is showing us? Well, what it's showing us is that from this movement from which the price is starting to have a retracement, is showing us where the price could have a reaction. It could be potentially a bounce to then continuing our movement upwards. So basically it's showing us that the price could perfectly do something like that, but also it's showing us that the price could, instead of bouncing on the 50%, it could even go down to the 61.8 or even the 78.6% level. But as I said, statistics show that when we have a retracement below the 50%, and in fact when it gets between the golden zone of the 61.8% and the 78.6%, it is very likely that the price will have a bounce, and therefore it is considered a very, very good zone. In fact, everything below the 0.5 level, it's considered a very good entry zone for a long position, and in the case you are using it for a short position, it would be exactly the same, but we would just draw it the other way around, so from the top to the bottom. In fact, let's say we want to see, we have this movement from this point all the way down here, and then we start to see a small retracement, but we don't know how far it can go. Well, we would use it like that here, and approximately we would get the levels like that. I'll just remove that one to avoid any confusion, also that one. So now here we have the potential retracements. As we can see here, that in this case it has just slightly touched the level of the 0.5. For some people who are not as conservative, they would have even entered a long position here, which would be also still a good indication. So basically the Fibonacci retracement tool in this case would be indicating us a good short opportunity, expecting some reaction, and in fact here a rejection on the area of the 50%. So using this tool, it would have been a successful trade. Now going back to the original example, when you use the Fibonacci levels as an entry for a short or for a long position, I strongly recommend you to place your stop loss always below where the movement started. So basically that would be invalidating our trade, and therefore it would be a good point for setting our stop loss, and exactly the same would apply for a short position. Alright guys, that's it for today. Let me know down below in the comments what do you think about this trading tool, and also if you have already used it back in the past or not. Said that, if you found this video useful and you feel like you learned something, feel free to go down below and press the like and subscribe button. I'll see you in the next one.